So welcome to yet another amazing revision session of CFN Financial Reporting Index 2. So if you are watching this on YouTube and if you are watching this without subscribing to the channel, it won't help. So first subscribe and then watch. In this revision video, this is going to be in 100% English, where we are going to revise the concepts as well as the important questions, right? So without wasting any time, let's start the revision in 3, 2, 1 and go. First of all, we started with Index 2 inventories. What all points are there? So first point is definition. Now what is the meaning of definition? See, whenever anything will come in inventory, when it is held for sale in ordinary course of business. Now there can be two types of business. If you are into manufacturing business, you will have three inventories: raw material, WIP, finished goods, held in ordinary course of business. Okay. But if you are into trading business, trading business, then in that case you purchase item and sell it as it is. You purchase at a lower value, you sell it at a higher value as it is. When you are into trading business, whatever you are purchasing and selling, that is your finished goods. You will not have any WIP or raw material. Anyways, so this is your definition. Then measurement. You will measure at cost or NRV, whichever is lower. Okay. When comparing cost NRV, you can do item by item comparison or group of items comparison. Any ways you like. We discussed this in illustration number 17. Also, the second point, it is written. What is the difference between NRV and FVLCTS? Do remember, NRV is a entity specific value. For example, if I sell it, how much will I get? Entity specific value. And FVLCTS is general market selling price. If anyone normal sells it in the market, how much they will receive. Okay. Next point, cost of inventories. So if you are into trading business, that means you purchase the item and you sell it as it is. So in your cost, only cost of purchase will come. That will include purchase price, less trade discount, add non-refundable taxes, add all the directly attributable expenses. Okay. But if you're into manufacturing business, you will purchase also, you will incur conversion cost also, and then you will sell. So what will come in conversion cost? Direct material, direct labor, direct expense, factory overheads. In factory overheads, there are two types of overheads. One is variable overheads, one is fixed overheads. To find the per unit cost of variable overheads, you will divide total variable overheads by actual capacity. But to find the per unit cost of fixed overheads, do you remember the hint? We will divide by normal or actual, whichever is higher. Why so, sir? Remember, I gave you some example in the class itself that for fixed overheads, normally we divide by normal capacity to find per unit cost, right? So we divide by normal capacity, we get the per unit cost, right? Now out of this total fixed overheads, how much will you add to the cost of inventory? Whatever you manufactured in reality, multiply by per unit cost. Balancing figure you get is the unabsorbed cost transferred to P&L. But let's say if your actual production exceeds normal capacity, in that case, don't divide by normal, divide by actual. Why? Because if you divide by normal, it will lead to over allocation of overheads, which is not allowed, right? So you will divide by actual capacity. So for fixed overhead, always remember we divide by normal or actual, whichever is higher. Simple. Then this was the cost of inventory. Following amounts will never be included in the cost of inventories. Which are those amounts? Any abnormal cost, storage cost, admin, selling, interest. Okay, whatever you incur will never be added to cost of inventories. Acha, there is one important point for storage cost. Normally, storage cost is incurred after the inventory is ready, but before selling it. So we do not capitalize in the cost of inventory. But sometimes, for some inventories, storing is necessary part of manufacturing. For example, wines and pickles. To prepare wine, we have to store it. So when storage is a part of production, at that time storage cost can be capitalized in the cost of inventories. Anyways, next point is allocation of cost to joint products and byproducts. Sometimes what happens is you are manufacturing two products together and you are incurring cost together, but you don't have the bifurcation of the cost. Example, Amul company prepares cheese and butter. They incur 10 lakhs total cost, but don't have the bifurcation of how much out of 10 lakhs was incurred for cheese and how much was incurred for butter. Now what to do? In that case, and also there can be a byproduct which results, right? Like buttermilk. So what to do? First, calculate total cost. From this total cost, calculate the NRV of byproduct. You will get the net cost. This net cost will be allocated between cheese and butter in the sales ratio. Now, how to calculate sales ratio? Selling price per units into number of units produced. In this ratio, we will bifurcate the cost. Simple, right? So this was allocation of cost to joint products and byproducts. Okay. Then cost of agriculture produce after the point of harvest. Remember, if after Index 41, you come in Index 2, right? When do we come in Index 2? When that agriculture produce becomes after the point of harvest. So when you are coming from 41 to Ind AS 2, the FVLCT of Ind AS 41 will become cost of inventory for Ind AS 2. Simple. Okay. Then next is cost formula. What cost formula to apply? If inventory is not interchangeable, we discussed we will apply specific identification method. If inventory is interchangeable, it can get mixed up. So you can apply FIFO or weighted average. But sometimes estimating the cost itself becomes difficult. In that case, you have two methods: standard cost method and retail method. Standard cost method, we apply standard costing technique, which we learn in costing chapter, right? In retail method, what do? We do reverse calculation. We have the sales figure. We calculate the estimated gross margin in our business. Estimated. So from selling price, you will deduct the GP, you will get the estimated cost. Okay, done, sir. So initially we discussed everything about cost. Now in the 7th point, we will discuss about NRV. NRV is to be discussed for 3 items: FG, WIP, raw material. For FG, what is the NRV? It is selling price of FG minus cost to sell. You get the NRV of FG. What about WIP? So WIP, you do not have direct NRV. So what you do, you take the selling price of FG less cost to sell, and because you are taking everything of FG, you need to deduct one more extra cost, that is cost of completion. You will get the NRV of WIP. Then raw materials. Raw materials, company will never sell it directly. It will consume it into FG. So the raw material calculation will depend on FG. If FG is sold above cost, that means FG is sold in good profit. Your RM is proper, you can measure the RM at cost. But if your FG is sold below cost, that means your FG is at loss. There is a high possibility that the market price of your RM must have reduced. So you will measure the RM at replacement cost. Simple. Clear with this, guys? This was the talks of NRV. Then next 2 points are writing down of inventories to NRV and reversal of write downs. Let's say in the first year your cost was 100, NRV was 85. So you will measure at lower. So you will have to bring from 100 to 85. That is write down. So you will transfer this write down to PNL. But if for the same inventory in future NRV rises, so you can reverse this write down. How much reversal is possible? Maximum. You can reverse maximum only 15. Simple. Then next point is derecognition of inventory. When will you remove the inventory out of your books? In 2 cases. Either when it is sold. So when you sell, let's say you have a cost of inventory of 100, you sell for 120. How will you recognize the sale? So whatever is the cost, transfer to COGS, book the revenue separately. By way of trading account GP, you can book the profit. Okay. What if your inventory is not sold but used in the construction of PP? So you will add the value of inventory to cost of PP. So you will derecognize the inventory and add to the cost of PP. And once you start depreciating PP, by way of depreciation, this amount will go in profit and loss. Right? So these are the concepts of Ind AS 2. Of course, in FR, it is of course incomplete without revising questions. So we will also revise questions now. Okay. Thank you so much. Yes. So let's start revising the questions. For Ind AS 2, we did the conceptual part. Now we are doing the questions. Of course, we will revise those questions which are more important, which have more adjustments. The remaining question, you can just give it a read, right? Because the main motive here is revision. Of course, also one more thing, the question which I'm revising, please do write and practice at least those questions. Remaining questions, even if you refer, it is more than sufficient. Chalo. The first most important question of Ind AS 2 is illustration number 8. What is there in this question? So it is said that we have one byproduct, 2 main products apart from scrap. So the hint in this question was we have 2 main products and ideally we have 2 byproducts also. Sir, how come? 1 byproduct and 1 scrap. Scrap is also a byproduct only. Do remember that. Then whatever cost to incur is given, your output is given, stock units are given. Market price of main product is given. Sir, why market price is given? Because do you remember in case of joint products, total cost is given. We need to bifurcate a total cost between main products. How will you bifurcate? In the ratio of sales, right? Okay. Then it is given byproduct is sold at rupees 20. So if your byproduct is sold as rupees 20, you remember for byproduct we need the NRV of byproduct so that it can be reduced from total cost. So it is sold at rupees 20. You manufactured 2000 units at rupees 20. It will come to 40,000, right? Then you will say there is a profit of 5,000 on sale of byproduct. The amount of profit on byproduct is irrelevant. I want the NRV of byproduct, right? So what is NRV? Selling price minus whatever the cost to sell is there. So cost to sell is given. It is given how much? It is given 8,000 and 2,000. So I will reduce it. Total 10,000 I will reduce. I will get NRV of 30,000. And what is the NRV of scrap? It is given as 5,000. So I will take that. Okay. You are required to calculate the amount of closing stock. So how will you do it? It is a very simple calculation which we just did, in case you remember. It was something like this. So we took all the total cost. Acha, for fixed overheads, we take the full amount as no normal or actual capacity is given. So I take the full amount. Okay, I get the total cost. Reduce the NRV, you get the net cost. Okay, reduce the NRV, you get the net cost. Now this net cost will be bifurcated between MP1 and MP2 in the ratio of sales. How will calculate sales? Number of units manufactured into selling price. Same for MP2. Okay, then in this ratio only you will allocate a total cost. Okay, you get a total cost of MP1, total cost of MP2. Now total cost was not asked, only the amount of closing stock is asked. How will you calculate this? Divide the total cost by number of units. You will get cost per unit. Okay, then multiply the cost per unit by the units of closing stock. You will get the amount. Simple. It is simple. Just practice it. Okay, then one more good question is, I guess, illustration number 16. A fantastic question. Please do give it a read. I will, of course, revise this with you. What is there? So we need to again find the value of closing inventory. How do we find it? So now opening inventory is given, few expenses are given, closing inventory is also given. So when you are calculating the cost, please remember one thing, that normally we take whatever we purchased, the full amount is added. But whenever opening inventory of RM is given, you will take raw material consumed. Whenever opening and closing of RM is given, RM means raw material, you will take RM consumed. So you will take opening plus purchase minus closing. Okay, in that case you will get this much units, multiply by the cost per unit. How will you get this? It is given now. You purchase 10,000 kgs for 1 lakh, so cost per unit is rupees 10, so you will take that. Okay, then add the labor amount. Now while adding the fixed overheads, in this question expected normal production is given, but actual production is missing. You have to find the actual production. Why, sir? Because we will divide by normal or actual, whichever is higher. How to find the actual production? This calculation is important. Just remember the basic formula. Opening plus purchase minus closing is equal to sales or COGS. FG, we are not purchasing, we are producing. So opening we have, production we want to find, closing is there, sales is also there. With this you will get the FG production. Okay, so actual capacity is 10,200, normal capacity was 15,000. We will divide by normal capacity. In that case you will get per unit. Now how much to be added to cost of inventory? Divide this per unit by the actual production. You will get this much amount. You will add remaining amount of overheads, you will transfer to profit and loss. Do remember that. You will get total cost divided by the fixed production per units, divided by the fixed production units, you will get cost per unit. Now you get the cost per unit as 22.5, but in question NRV also give, NRV of FG is given, it is given as 20. So we will value at 22.5 or 20, whichever is lower. Okay, so we measure at that is lower amount. Acha, because FG is measured at lower of cost, remember RM will be measured at replacement cost. So do that. Done with this part. Clear? Okay, so what are the 2 points which are important? The first point is RM consumed calculation, and the second important point is FG actual production calculation. Don't worry, I will upload this notes on Telegram also. You can download it and use it for a reference. Telegram link you can get in the description also. Anyways, chalo. Then one more important question was illustration number 21. It is a good question. You can just refer. I will just give the basic calculation of it. So you are given full capacity, normal capacity, actual capacity. When full, normal, actual 3 are given, full is of no use. Take normal and actual for fixed overheads. Okay. So basically you want to find the value of closing inventory and value of COGS. How will you find this? So first fixed overheads you will divide by normal, actual, whichever is higher. You got rupees 2.2 per unit. Variable overheads you will always based on actual divided by actual number of hours. You will get per unit. Okay. This is the cost per unit. Now closing stock units are missing. Apply that formula. Now opening plus purchase minus closing is equal to sales. Through this formula you can get the closing stock amount. Opening is given, sales is given. Sorry, production is given, sales is given. Closing stock you can find with this formula. So you get 2300 units. Now the cost per unit is 0.6. So you will get this closing stock amount. Now, normally COGS, how do we calculate? Opening plus purchase minus closing. In this question, as per ICI has ignored the opening part. They have only taken purchase minus closing. So with that, if you take this, you will get units at 4200. Multiply with this cost per unit, you will get amount to be added in COGS. Also, there is one more amount which will get transferred to PNL. Not added in the COGS, but will get transferred to PNL. Which amount? Fixed overheads, which are unabsorbed. This is the calculation. This will get transferred to PNL. Do remember that. So this was illustration number 21. Then illustration number 23 is also a good question. Just remember one concept in this. When PPE is used to manufacture the inventory, in this case, depreciation of PPE will be added to the cost of inventory. When you use any PP, let's say if I'm using a plant to manufacture this mic, this is my inventory. So the depreciation of that plant will get added to the cost of mic. Okay, it will not be transferred to P&L in that case. Okay, so then various costs are given. Let me tell you, all costs are to be capitalized. Okay, so just give this a read with this concept what I just told you, and you will understand. It's a very simple question. Then we have question number 4. Again, a good question. What is there? So basically some cost is given for purchase. Acha, one more thing. Just remember one thing. In question, whenever it is asked to compute the cost of inventory. Okay. So in that case, two types of cost might be given. One is purchase or manufacturing cost, which is relevant to make the inventory. It will be added to the cost. But if any kind of selling cost is given, that was incurred to make the sale, that will not be added to the cost of inventory, because it was not necessary to manufacture the inventory, it was necessary to sell the inventory. That selling cost will not form part of the cost. Do remember that. Now it is given that in this question number 4, it is said that you incurred a cost of 1,30,000. Out of this, 10,000 was refundable, so reduce it. Okay, now two types of transport cost were given. One was incurred on purchase, one was incurred on sale. The transport cost incurred on purchase will be added to the cost, but transport cost incurred on sale, it is a selling cost, transfer to profit and loss. Similarly, selling cost for that, transfer to profit and loss. Achha, so this was the first part of it. Okay, they have asked the cost of inventory and little bit reasoning. Just give it simple. Point number 2. Now there is a point of decommissioning involved here. So basically, what is decommissioning? We learned that in India 16 PP. So whatever the amount of decommissioning is there, we add it to the cost of PP normally at present value. But in this question, it is said that the decommissioning was not incurred because of PP. It is getting incurred, it is arising due to manufacturing of goods, that is manufacturing of inventory. So decommissioning in this case arises because of manufacturing of inventory. So when any amount arises because of inventory, it will get added to the cost of inventory and not the cost of PP. So decommissioning normally we have learned we add to the cost of PP, but in this instance it will get added to the cost of inventory because it is getting incurred because of inventory, right? So I guess these are the questions which we have covered. Of course, try to take the tricky questions in this revision. Remaining question, of course, you can refer. It is a very simple index. I hope you like it. If you like it, do comment, do share it with your friends, and thank you so much, everyone. Also, in case if you want to recommend my lectures to the friends, they are available on bbvirtuals.com, so you can definitely refer them. In case you might not need it, your friends might do need it, right? So you can definitely recommend. In case you like, then only recommend. Thank you so much. Bye bye, everyone. Take care. See you all. Bye bye.